Hello and welcome to Raj Sabha TV. You watching discussion today with me, Rajat Kain. Well, the idea of setting up a bad bank to resolve the growing problem of the non-performing assets or the NPAs, loans which are not coming back, is back on the table. With the scenario of commercial banks seeing a spike in the NPAs, the bad loans, in the wake of contraction in the economy as a result of the COVID-19 pandemic, and this contraction in economy was seen worldwide. The Reserve Bank of India and its governor Shaktikanta recently agreed to look at the proposal for creation of a bad bank. So what is the concept behind a bad bank and how it's proposed to tackle the problem of NPAs? To discuss more on this, we are joined with a panel of two guests. We are joined with Mr. Ajay Shankar, he's former secretary, DIPP, Ministry of Commerce, and Mr. Sidhartha, he's senior journalist, and he's economics affairs editor of the Times of India. Well, many thanks for joining us, gentlemen. Let me start with you, sir, Mr. Ajay Shankar. For a benefit of viewers, could you explain the concept of the bad banks and how it's being perceived as a tool to tackle the bad loans, theoretically at least?
Every bank, and in normal times also, finds some customers who are unable to repay their loans. And these are non-performing assets. And some level of non-performing assets are normal to banking. Now, in India, what has happened in recent times has been that there has been a cleanup attempted by the Reserve Bank of India of how banks were handling loans which were not being paid in time. So banks would try to hide the problem under the carpet and keep restructuring loans and not show them as stressed assets or assets which needed a write-off or a write-down. So the Reserve Bank of India woke up to the problem under the previous governors' regimes, and they tightened the scrutiny of commercial banks and insisted that they should make provisioning for assets which are stressed and then declare them stressed non-performing assets. This cleanup was combined by the setting up of the Indian Bankruptcy Code, which provided a more efficient way of sending a borrower or a firm into bankruptcy, for resolution professionals coming into place, for a fair valuation of the assets, and the sale of the firm, if that was viable, or the sale of physical assets, if the sale of firm was not viable.
Okay.
Now, all this process was moving and settling in. Then what happened is that in 2018, for a variety of reasons, the Indian economy growth rates started coming down a bit. With the coming of COVID, we had a shutdown and the economy shut down. So I think the government and the RBI very wisely decided that these are extraordinary times and therefore we need extraordinary measures. So the bankruptcy process of the IBC code was kept in abeyance and is still in abeyance. The banks were, there was a moratorium on debt repayment, and now the RBI, under the advice of the Kamath Committee report, has given guidelines for banks to restructure existing loans. The government also came in with a 3 lakh crore provision of a government guaranteed debt to MSMEs to make them survive. Now, the RBI in its latest report has said that, yes, once normalcy returns and the bankruptcy proceedings are brought back to normal levels, then bank NPA levels will rise to over 13% and in the worst case scenario over 14%. Now, this is much too high. Now, there is another problem that has been there and because of which many banks have been requesting that a bad bank be created. Because within a particular bank, the tradition and the confidence level of taking the haircuts needed with a borrower who is in difficulty, but with a write-off would survive. So that capacity has been modest and it's partly been impaired by the fear or anxiety of subsequent scrutiny. Because the fact is that we've been proceeding quite harshly against people who misappropriated bank loans. But if you do write off loans, companies can survive. So I'll give a very simple example which viewers will relate to. When the Delhi Vidyut Board was privatized, a new three companies were created and they were given clean balance sheets. So all the previous debts were written off. And then with good private management, the distribution companies of Delhi have been yet declaring profits.
Okay, okay.
In the privatization of Air India itself, the idea that has continuously been advocated that unless you take away all the debt, the chances of the new take over airline performing well would be reduced and you may not get buyers. So it makes sense to write off debts provided there is confidence the company can be run. So the idea behind the bad bank is that these decisions are difficult and complex decisions. So instead of individual banks taking these decisions, you take all these difficult debts, put them in a bad bank, and there you will hopefully create the capacity to take sensible decisions quickly and the optimal decisions quickly so that the banks get back a share of their loans to the extent it's practical and feasible. And the companies either get into commercial activity quickly with the hope of doing well, or they go into liquidation and sale of assets. So that's the idea behind a bank. And right now, since the NPAs are expected to balloon after the moratorium on IBC process is removed, there is a feeling that this is the right time to create a bad bank. And there is one more dimension that if a bank has a clean balance sheet, then the confidence for risk taking and fresh lending rises. So the banks would have to lend more confidently to meet the needs of an economy which should go back to recovery and high growth.
Right. Ms. Ajay Shankar, many thanks for your opening remarks. We'll certainly come back to you to discuss the other dimension of this concept of bad banks and how feasible they are. Let me go to Sidhartha. Sidhartha, off to you. This, as Mr. Shankar just pointed out, that it's highly essential to have the loans written off, or at least have a part of the loans back to the banking sector. Now, this concept was mooted earlier as well. Is it so? And if it was mooted earlier, what were the circumstances, the reasons for which it was kind of put in a cold freezer?
If you look at this whole bad bank experience, it was after the Asian financial crisis. A lot of these countries tried it and it worked there. We also had our own model of a bad bank in 2002 when Secy was enacted, which was the predecessor to the insolvency code. Asset reconstruction companies were set up where bad debt was transferred. And what it did was that you kicked the problem somewhere else. So instead of those bad debt being on the books of the banks, went on to the books of those asset reconstruction companies. RSIL was set up, and then the RSIL was set up by a group of banks and financial institutions. I mean, all these banks were there as shareholders. Then you had these private sector asset reconstruction companies. Now, there are two problems with it. One is that the criticism is that it is sold at a huge discount. So if an asset is worth 100 rupees, it would be sold at 15 rupees. And from a bank's point of view, so that if it's a write-off, which means it has been technically been written off, that 100 rupees value on the books of the bank is zero.
Yes.
So, you actually sell it at 15. So you technically book a profit over the remaining period of that loan. So if it's a 20-year loan and you sell it after 10 years, it is amortized over the remaining 10 years. And in a large number of cases, these ARCs then sold those loans. And what also happened was that if you remember, in 2003 onwards, the economy picked up, and those were the boom years, 2003 to 8.
Yes.
And so typically these assets which were sold for 15 rupees fetched 50 rupees or 60 rupees or whatever. So which was not the experience with RSIL, which was a bank-driven thing, but with the private sector ARCs. So but post 2008, you had this whole cycles of ups and downs, and we've been through many many troughs and small peaks, but we haven't really come out of the woods yet. And but at some point of time, banks realized that what they were getting was not worth it because they came in the form of those receipts, SRs, securitized receipts, and so which were difficult, and they didn't get it in one go, and so there was a reluctance. In any case, in the banking industry, especially in the public sector bank space, there has been a reluctance to take decisions, whether it is lending or whether it is selling assets at a discount or whatever, because of this fear of these investigation and CAG and whatnot. Okay. So the problem is not with the model as such, with the current model as such. The problem is with taking decisions at the public sector bank management. And frankly, this bad bank is kicking the can somewhere else. So that's my view on that.
Right, that is very important. Mr. Shankar, you also agree or think that there is a problem with the decision-making process. Perhaps the concept on its own may not be that problematic, but there seems to be decision-making process that happens to be the problem. Do you also agree?
I more than agree, because the whole case being made out that we must privatize our public sector banks as soon as possible is based on the premise that we are incapable of getting the managements of public sector banks to perform well. Now, I think as a principle, I think it should not be acceptable that government is incapable of making its public sector institutions or government controls bodies perform efficiently. They have performed efficiently in the past and they can be made to perform efficiently. So I think if a new bad bank is created, then before it is created and before it's designed, this issue of giving confidence to those who run it to take bona fide commercial decisions and be assured that their decisions will not be subject to adverse scrutiny unless they have personally gained in a quid pro quo kind of transaction. And today, tracing quid pro kind of transactions or equivalent of a bribe is not difficult. When the agencies want to do it, they're able to do it well enough. So whatever institutional mechanism we create, unless the confidence is there to take commercial decisions quickly enough, we will not go very far, and it's been rightly pointed out that we may end up kicking the can down the road. Now, one other dimension that is important is that for the new bad bank, if it is to perform better than the older asset reconstruction companies system, is that some degree of government handholding, if not ownership, would be useful both in terms of giving confidence as well as in giving market participants confidence that this is something which is worth taking seriously. Because the problem, as was pointed out by the earlier, was that you had some assets being sold what later on appeared to be at an artificially low price, and then difficulties in selling off other assets. Now, in the sale of assets, one other dimension which I think I should point out here is that if you look at the valuation of a company, you see one set of numbers. But if you assume that the company has stopped working and you just look at its land holdings and you value that at market value, then you get a completely different kind of figure. So whichever sales take place, I think some way of creating this kind of a firewall between the value of the land and the value of the company, or the use of land for other purposes, would be necessary. So I again come back to the experience of the electricity privatization, that the land with the private companies is not available to them for using for other purposes, and they're not really owners of the land. They have it on some very strongly structured lease or license conditions. And if this is taken care of, then some of the adverse comments that came up in some other privatization transactions of an earlier period, those would be avoidable. Those could be avoided. So the design of how this bad bank will work and putting in the right management in the first generation of leaders would be the key to success. But clearly this would make a huge difference if it works very well, because then the September projection of 13.7 or 13 plus NPAs figure could probably come down a little. And if the banks were owners of the bad bank partially or to a large extent, then what they lose by the write-downs today, they may gain in the increased valuations later on. of the bad bank or the assets that it sells.
Right, right. That's important. That's really important. Sidharth, now we've been discussing about the concept of bad banks and on, and of course, like I mean, how essential it seems to be in terms of the rising NPAs. What has been the RBI's stand on it, like throughout the last decade or so, as or for that matter, even lesser, as we've been seeing that concept has been doing rounds, and you also explained in your earlier reply. What has been RBI's stand on the concept per se of the bad banks?
See, RBI fully endorsed it in 2002 when these asset reconstruction companies were created. Now, this whole idea of a bad bank, regerminated a few years ago when Mr. Arun Jaitley was the finance minister. And at that point of time, so this would have been about 4 years ago, maybe. I don't remember the exact year, but then it was rejected, both by the government as well as the Reserve Bank of India. The government thought that, administratively it was difficult. Politically, it was difficult because, you transfer company X to an ARC with a loan of, say, 1,000 rupees and you transfer it at 200 or 300 rupees. There are bound to be questions and controversies around that. So politically, it was thought to be unfeasible.
Right.
Then RBI had its own set of concerns, and it didn't take off. Then it was rejected. And typically, it comes up before every budget. In 2000 and maybe 3 years ago, there was a committee which was set up with Mr. Sunil Mehta, who was then the PNB chairman, Mr. Rajnish Kumar, who was then the SBI chairman, and a few other bankers were there. And they came up with a slightly altered model of a bad bank in the form of an asset management company, which would then have these companies which would take over assets and do the hand-holding or whatever restructuring, etc. But even then, both the government and RBI didn't find merit. Last year, again, this issue had come up, and typically it is emanating from the banks. From a bank management point of view, it helps them, I would call, window dress, if I could use that term, the accounts, because what happens is, say, as is the estimate of 7% NPA at the moment. Now, if you can sell even half of that, so from a bank point of view, that your gross NPA comes down to 3.5%. And so your books look better, but the problem is not solved. You move that 3.5% to another company where it is housed. So from an economy point of view, it doesn't solve the problem. But from the bank management point of view, your house looks painted and nice and clean to look at.
That's very interesting point, Sidharth. From the economic point of view, it doesn't quite solve the problem, whereas from the banking point of view, it does, of course, have, as you mentioned, window dressing. Now, here comes a moot point, Sidharth, before I go off to Mr. Ajay Shankar and close the show. Then what is the feasibility of this concept, in the economy? And of course, like as we have seen contraction in the economy due to COVID pandemic. And what is the scenario we're seeing for the NPAs? Will it rise further? And if it's so, and if we work on this concept, so how does it address the larger question of the economy?
See, as RBI itself has said, and as Mr. Shankar pointed out, there is, according to RBI's estimates, there's a projection for a huge spike in NPAs.
Okay.
Now, even the current, value of NPAs that you're seeing on the books of the banks is not the real value, because as Mr. Shankar had pointed out, there are various, schemes in place, such as these moratorium, etc., have come in. You're not doing this IBC thing, so so the real value of NPAs will actually show maybe a quarter or two down the line, and there is a huge buildup of NPAs which is expected because of this whole pandemic thing, and because a lot of businesses are still facing cash problems. Some have come out of it, some have not. And so obviously they are going to have face a problem. Now, a solution there is that, from a bank point of view, there are two ways to deal with the issue, and this is something that is provided for in the RBI guidelines. There is a time-bound restructuring route which you can follow.
Okay.
But that involves decision making, which, as we discussed earlier, is difficult in with bank managements these days. They're not willing to take that decision, to make that call. So you can either restructure those loans, or if you think that there is no way that the current management can salvage the company, then you use the IBC route, the Insolvency and Bankruptcy Code. Send it to a national company law tribunal and find a new owner for the company.
Okay.
So those are the two options that are available. And or the third is that if it's a dead asset, you have no choice but to write it off completely, and then sell the assets or do whatever to recover value you can recover. But coming to your issue, there is a huge buildup of NPAs which is anticipated, and this means that government will have to provide a lot of capital to these public sector banks, and the private banks will have to raise capital if they also see an NPA increase. Alternatively, if this bad bank comes in and those assets are sold, the recapitalization requirement of the public sector banks will come down, but you will have to provide capital to the bad bank. So you have to provide capital whether you put it in this pocket or this pocket is a call that you have to take.
Right. Thanks very much, Sidharth. Mr. Shankar, just as we close the show, sir, a very short question. How feasible do you see the concept of bad banks vis-a-vis the scenario of Indian economy? And of course, like if we take into consideration the momentary issue of the rising NPAs in future, and this is what the RBI's report itself is saying, there will be a spike of NPAs in some days to come. So how feasible do you see the concept of the bad banks? Mr. Shankar?
I think the bad bank could do a lot of good, provided we create a decision-making structure that is better than what exists in the banks today. I think it's doable, because when you deal with a certain kind of assets every day, your capacity to take good decisions improves, and if people are given confidence, I'm sure they'll take good decisions.
Right.
But there is no such thing as a free lunch in an economy. So we have to pay for the losses of the COVID period. And the only way to pay for it is to see how much can be salvaged on a much higher growth trajectory for the economy. So if the economy really booms to the great growth period of the first decade of the century, then all this NPA problem will become much smaller if you roll the can down the road and restructure debt for a longer period. But the economy doesn't get into a very high growth trajectory, then the price has to be paid through higher write-offs and more capitalization of the banks. So the whatever is done has to be done in the context of what can we do to get the economy going into a very high growth trajectory as soon as possible.
Just one last word, sir. Just very, very briefly. I just have a minute to squeeze in here. I'm sorry.
Yeah.
Will you also term, if at all, the theoretical concept of bad banks comes into formation? Will this be categorized as a bold decision or bold reform category?
Certainly. Right, because if you can get hold of these companies which are in difficulty, clean up their balance sheets and get them to start performing in the economy quickly, either with existing promoters or new promoters. Because the key is that you have a company, and the sooner it starts performing well in the market or with confidence, the better it is, unless it's so hopeless that it should be written off, and then that should also happen very quickly.
Well, that's it, sir. Many thanks. We have to leave it here. Many thanks, Mr. Ajay Shankar. Many thanks, Sidharth, for throwing light upon this extremely important concept. Theoretical, nonetheless, but certainly it's important to have brainstorming on this concept of bad banks, if at all it will be feasible for our economy or not. Well, many thanks for watching this edition of Discussion Today. Thank you and goodbye.